Well, like I said, during good times for real estate, you can make money in a ton of ways. You can make money by doing deals. You can make money by refining deals. But when times get tough, when there are no deals to do, when the debt's not cheap and you can't refi deals and you can't get fees that way and it's not a good time to sell, you are forced to sit and hold and operate real estate. A couple quick thoughts that I'm thinking about recently. Got a head cold. Forgive me for sounding a little nasally. But number one is drive-by traffic. We were doing an analysis recently on all of our facilities, how they're leasing, how they're doing. And overall, our portfolio is still performing really well. I made some tweets in early July about the lack of move-ins compared to last July. It ended up being a busier July, so I was wrong on that. It must have been just a slow week. We leased up 2.5% of our portfolio this month in July. That's a lot of units. Not as many as April, or not as many as May, about the same as June. So pretty busy, pretty good month. One thing we're realizing that I have never talked about on here before is the significance of a good location as far as visibility and drive-by traffic. We have about 7 facilities of our 55 that are on really busy roads. We're talking 15,000 cars a day. You can directly see our storage facility. Everybody knows where it is on a very busy road. Those facilities are all crushing it. We can't lease units fast enough, or we can't keep units available. We can't raise rents fast enough, and they're just outperforming by a mile. Now, the facilities that aren't on a high traffic road, that doesn't mean they're not going to do well. Again, we don't have very many facilities in our portfolio right now that aren't doing well. They're almost all doing well. But there's not a single one with a lot of traffic that's doing poorly. So high traffic, meaning 5,000 plus, 10,000, 15,000 cars a day, almost always means a facility is going to crush it. Low traffic doesn't necessarily mean a facility is not going to do well. We got some that have absolutely no visibility that are doing phenomenally well. Can't explain it. I don't know. But the drive-by traffic is directly correlated to outperformance. We bought one in North Georgia, right across the street from a Walmart, right next to a car dealership on the busiest road in town. And they were already charging the highest rents in the area. I had a good feeling about the deal. My coworker, CFO, who helps me underwrite the deals, he wasn't sure about it. And I had a good gut feeling about the deal when we were underwriting it. We were right on the edge. We decided to buy it. And it has performed phenomenally well. We are now way above the rest of the market in rents and continue to lease units well. And the number one reason why is because of the drive-by traffic. It's on a great road. Now, take from that what you please, but recent thought, and it's been important for us. Second thing I want to talk about is fees. Management fees, how much you're charging to manage your property, is an important piece. And a lot of investors, they'll look at our deals and they'll look at my management fees, which we charge 6% of revenue, gross revenue, $3 per unit per month. And we take the tenant insurance revenue, tenant protection revenue that's brought in. And you might ask how that works. Well, a tenant gets tenant protection for $9 a month to protect their unit. We require it. About half that, or 75% of that, depending on the location, is profit revenue for the facility. We take that as a management fee. Our all-in net management fees are anywhere from 12 to 15% of gross revenue. That's what we charge to do all the work to manage a facility. That's hire the contractors, oversee the call center, do all the work. Now, compared to people who are on our level, on our, buying small tertiary storage, our fees are high. Some of our competitors I've seen literally charging 5% of revenue as a management fee, and they're remotely managing these properties. I'll tell you that you just cannot make money doing that. Public Storage, they're around 13.5% their management fee. CubeSmart, they're 12.5% or so. Extra Space Storage, who I think is the best in the game at managing self-storage, they're almost 15% of gross revenue as their management fees, what it comes out to after it's all said and done, and they take all of tenant protection. That's about what they have to charge to make money. But listen to this is the really important part, is that Extra Space Storage, Public Storage, CubeSmart, they're all going to put full-time managers on your site, and the entity is going to pay for that. So they're going to put a full-time staff in place of $80,000, $120,000 a year of payroll on site, and they're going to answer phones, they're going to move in units, they're going to sweep units, they're going to do billing, they're going to do collection calls, they're going to do a lot of things for the facility Whereas we do that all in-house remotely. Now, our management company, I've got about a little over $1 million in overhead on the management side. This doesn't include our finance team. This doesn't include our acquisitions team. They're paid out of different areas. They don't do a lot for management. But our revenue is about $1.2 million in management fees. So 20% profit margin, not even, a little bit less than a 20% profit margin with my fees that are much higher than other operators who are doing this. Now, what can we learn from this? What can we take away? And what would I advise you? When business is good, when real estate is humming, and when everything is going really well, syndicators, GPs like me, can make money on acquisition fees, on refinance fees, on the promote when they sell something, on doing deals. They're doing things, and they can make a lot of cash in the bank that way. And that can hide a not profitable management company, a management company that's losing money. And keep in mind, I have, of our management staff, which is about 30 employees of our 50 or of our 45, I have almost all of them overseas. 18 in the Philippines, a lot in Colombia. I'd say 60% are overseas. And I'm still only operating at 20% profit margin. Imagine if you had every single one of your employees was a $50,000+ a year employee in the States, how hard it would be to break even or make money on a management fee similar to mine. Now, where's the risk here? What's the problem? Well, like I said, during good times for real estate, you can make money in a ton of ways. You can make money by doing deals. You can make money by refining deals. But when times get tough, when there are no deals to do, when the debt's not cheap and you can't refi deals and you can't get fees that way and it's not a good time to sell, you are forced to sit and hold and operate real estate for a really long time. Now, I've set up my business to where we can do that. We have a moderately profitable, healthy management company that can afford good talent. We can invest in good people. We can make good decisions. And we can continue to manage real estate even if the market takes a really poor, stretch of years here. A lot of folks who are buying storage and other assets can't do that. I'm looking at the deal decks of some of our competitors who send out deals and syndicate deals. They are not profitable. Actually, I know that they are losing money on a management basis. How risky is that? That is insanely risky. As an investor, as an LP, I'm putting money with a sponsor who has a management company that's losing money. When times get tough, when real estate goes through a really rough stretch, when it's less valuable, when we're in a recession, whatever it might be, that company is going to be hemorrhaging money when everybody's struggling, and they're not going to be able to afford to keep or attract talent. And therefore, the management will suck, and the management will suffer. And that opens up a whole new ballgame because management is the risk factor of real estate. If you don't do a good job managing real estate, you can lose it all. I mean, overseeing revenue expenses is the most important part and the hardest part of what we do in this business. So if there's one takeaway from this episode, it's make sure that your management company is healthy and profitable in its own right. Don't just guess and charge what you think is a fair market, rate. You got to really run the numbers and see how much money you actually need to spend to manage these properties correctly. It's not just one VA. To manage a self-storage facility is not just you and one VA. Look, we have 53 properties now, of course, but we have a collections division. People who collect rent. That's their only job, is collect rent and auction off units, which is a huge, stressful, expensive job to auction off units that don't pay. Then I have a property improvement division. Their job is to fix things that break: overhead doors, gates, fences, signs. Then you have CapEx. You got to oversee new pavement. You got to do all this work on the site to make sure it's running well. Then you got to manage all the contractors. You got to not only manage the contractors, but you got to secure the contractors and hire the contractors to do your lawn care, your pest control, your snow removal, your door maintenance. Then you got to find a laborer and manage that labor to get on site and clean out the units. And the biggest one, which is 18 of our employees, is customer service, answering phones, renting units, managing revenue. There's a ton that goes on inside of our company, and every single one of our people is nearly fully utilized. It's very, very expensive to manage real estate. And some of these early deals that you're charging this low management fee because you think you can just manage it yourself, just you. As soon as you need to hire somebody to replace you, as soon as you need to hire competent people to make decisions and manage your properties well, you are hemorrhaging money just like that. So look at how public storage, extra space storage, and if you're in multifamily or in another asset class, look how the big time property management folks charge and what they charge for and how they charge fees for everything that they do. Because if they're doing work, they need to be getting paid for it, and model your own business off of that. Your underwriting will be much different than you actually think it is. You're going to underwrite more for management fees, but you're going to actually spend it. So people look at my deal fees and they think, oh man, Nick's management is kind of expensive. No, my management is damn near break even, but it's healthy. And that's the difference between me and a lot of people I'm competing against, is that when things get really hard, I have a good management team that I'm going to be able to afford to keep. And a lot of my competitors who are buying storage in small towns with a 5% management fee are not going to be able to afford to do a good job managing these properties when things get hard. So make sure you set your business up the right way. Juniper Square, the sponsor of this show, recently conducted some research to help you understand what real estate investment managers are doing to build stronger relationships with their investors and earn more referrals to new investors. Their new special report includes data on topics such as what factors are the most important for building investment relationships today, how technology is being used to provide a competitive edge, and the one technology integration that is driving more repeat investors and more referrals. To download this for free, visit junipersquareresearch.com. Again, to get this report for free, visit junipersquareresearch.com. Before you go, we have a new sponsor of the show, recostseg.com. And if you bought a piece of real estate, you need to get a cost segregation study done. It's what allows you to get all that sweet, sweet bonus depreciation, and it's how real estate investors like me and many others pay almost nothing in taxes on an annual basis. You can cost seg a single-family rental, a short-term rental, or a large commercial property. recostseg.com is affordable and aggressive and super fast to turn them around. They've done 10 plus cost segs for me this year. They're going to do many more for me. Visit recostseg.com to learn more.